Well, isn't this exciting? This is Dr. Fessler coming to you live from our classroom on a Saturday because audio video stuff messed up during class on Thursday. So I'm going to redo bits of our lecture, give you a short version of the lecture from Thursday, and knock on wood, I guess whiteboard's going to have to do. Knock on wood. We will have. I'll have better. I've already purchased some better technology, and we'll hopefully be able to do a better job of videotaping class on Tuesday. Let me check the everything here. Looks like it is rocking and rolling just like it's supposed to. The culprit seems to be that there is in fact buttons in this little ear doodad. And so we got another Bluetooth microphone, so I don't have to use that doodad. So you want to find the page in the handy you want to find the page in the handy handbook that says the balance sheet right here. Okay, you want to find the page in the handy handbook that says the balance sheet, and that is assets equals liabilities plus equity. And you should write those words down. Assets equal liabilities plus equity. It's also important to know that this is also the accounting. In fact, I think we've already talked about that this semester, right? This is also the accounting equation, And so this phrase, the assets equals liabilities plus equity, is pretty darn important. It's foundational, the accounting equation, and then it is used as the format of the balance sheet. So this is, in fact, the format of the balance sheet, okay? And then let's move on to the income statement. Move on to the income statement, okay? This is revenue minus expenses equals net income or profit, okay? Revenue minus expenses equals net income or profit, right there, okay? And the NI stands for net income, profit. These are synonyms. They mean basically the same thing. Revenue minus expenses equals net income, and that is the format of the income statement. Now, and none of that is new information for you. None of that is new information for you. We're reviewing stuff here because we're cool like that. Okay, now let's move on to the statement of cash flows. Now, to save just a little bit of writing, CF stands for cash flows. Cash flows from operating activities plus cash flows from investing activities, and then plus cash flows from financing activities equals change in cash, and then you add beginning cash, and that equals ending cash. Okay, let's see how that looks on the board. Now, if you find that I'm going a little bit too fast, because I am going a little bit faster than I did during class, there you go. You just stop the video, rewind the video a little bit, do whatever you need to do to make sure you get all the notes. But the statement of cash flows is cash flows from operating activities plus cash flows from investing activities plus cash flows from financing activities. And that equals, that's an equal sign there, equals change in cash flows. And then you add in what you started with, and that equals what you got now, which would be the ending cash flows. And again, these are all words we've already defined, right? Operating activities is the stuff that the business normally does to earn money. Investing activities is purchasing of big things, assets, and then cash flows from financing activities are transactions with with creditors and owners, or interactions with owners and creditors, whichever order you want to put that in. And then, and so we've already defined all those as well. So now we're starting to make use of terms that we've already used and learned. And then finally, the statement of stockholders' equity. And that's going to be beginning stockholders' equity, SE, stockholders' equity, beginning stockholders' equity, plus if you issue common stock, which is common stock now, is the stock that you would purchase if you buy Tesla. Or what have we talked about? We've talked about Tesla, we've talked about Apple. If you go out and buy a share of stock of Apple or Tesla, this is what you're buying. You're buying common stock plus net income for the period minus dividends. And what are dividends? If you have common stocks, some companies pay dividends on their stock because when you buy a piece of common stock, you are a part owner of that organization. Some companies, more than others and more frequently than others, will pay dividends on that stock, meaning they're paying you a little bit of the kind of the cash proceeds, the cash profits of the company. They're paying that to the owners, okay? And so, yes. And then finally, that equals ending stockholders' equity. Ending stockholders' equity. And I'm trying to write really big so you can see it at this odd angle. Something's going to be at an angle because there's a table right down here that is kind of in the way of the camera. So there you go. Beginning stockholders' equity plus any issuance of common stock, plus net income for the period minus dividends equals ending stockholders' equity. And just know that this issuance of common stock, this doesn't happen very routinely. These other two, net income happens every period, net income or loss happens every period. Dividends can happen pretty regularly. This doesn't happen very often in the life of an organization, usually right at the very beginning, right when they're seeking funds. They issue common stock. So this doesn't happen very often, but it is part of the statement of stockholders' equity. And recognize this equity, this word equity right there is this word equity here. So that statement of stockholders' equity, let me get the camera over there so I can point you at it. That equity right there and the equity over on the statement of stockholders' equity, those are the same thing. So the statement of stockholders' equity is a description of the activity that's going on in the equity section of the balance sheet. Okay. Now the unfortunate part of me doing lectures like this, the benefit, right, is they're shorter. They're always shorter, but the bad part is you don't get to hear the questions and answers of the students who are in class learning the material. And so I think that makes everything just a little bit richer, okay? It makes everything a little bit richer. So I wish I could ask you questions, comments, concerns, random thoughts, and then you could ask questions about the stuff that I just kind of went through, okay? Now what I'm going to talk about are the connections between these, okay? Between these. And these statements are not independent of one another. These statements are not independent of one another. For example, let's see, where do we want to start first? Profit. Well, there's a connection there, isn't it? So let me show it here. Now, what I've done, I don't know if you can see this. What I've done, there's links among the financial statements. And look what my notes look like. I don't know how well you can see that, if it's focusing on it really well. But what I've done is I've actually rewritten all this information on one page, links among the financial statements. And so everything that I've got on the board, I literally wrote down again on that page, because you just write small, put it all on one page. And because they're all interrelated, I'm going to suggest that you stop this video, take a moment, do that, go copy it all down. It'll help you remember them at any rate. And then come back and we can learn a little bit more about this. So, or learn about these links. So net income profit goes there on the statement of stockholders' equity. So it goes from the income statement to the statement of stockholders' equity. Then another one, ending stockholders' equity, from all the way over here, then goes way over here to the equity part of the balance sheet, okay? To the equity part of the balance sheet. So let's see those. See that one, the first arrow I drew is kind of nice because it all shows up on the camera at one time, but the board is so wide, which is pretty awesome as far as I'm concerned. So if you look down there, bottom right, ending stockholders' equity, and then you follow that arrow all the way down across the bottom of the board, keep following it left, keep following it left, keep following it left, and then all of a sudden, poof, there it is on the balance sheet. So these numbers are the same thing. Ending cash. Let's draw this a different direction. Ooh. There we are. This is, now, and let me be clear. So can you see that, all that arrow here? Yes, you can. You can see ending cash from the statement of cash flows. And then you follow that arrow, it goes left and then above revenue there and all the way over to assets. But it's super important. Somebody asked me this after class. I wish they would have asked this during class, but they asked me after class. And cash is not equal to assets. Assets equals cash plus accounts receivable plus buildings plus land plus equipment. So cash is just part of what goes in the balance sheet, but it's an important part, and the number that is here on the statement of cash flows would need to necessarily match the number that shows up on the balance sheet. And so there you go. What you have is no financial statement stands alone, does it? They're all connected to one another. No financial statement is alone. Every financial statement has an arrow either coming to it or going from it, okay? Make sure you got those drawn very carefully in your notes. And like I said, what I did was I drew all of those. I wrote all of those onto one sheet of paper so you can see them all at one time. Okay, so that'll be the best thing for you to do. Okay, and so that is links among the financial statements. Okay, and then finally, we're going to talk about what are the 4 financial statements. Okay, and so this is a bit of a review with a little bit of new information on it. Okay, So if you go, we'll put them in this order, okay? If you go to that page, notice there's 1, 2, 3, 4 along the left side. 1, let's do the balance sheet. And so again, I'm going to ask you and encourage you to write this down again. The statement is the balance sheet. The phrase at the top is as of the date. Because a balance sheet is a photograph. I would kind of use my camera to kind of pretend to take a photo, except my camera's right there, so I cannot. But imagine taking a photograph of all the cash, accounts receivable, the buildings, the land, the equipment that a company has on December 31st, 2023. And that's what companies did that have December year ends. So the balance sheet is saying, as of this date, this is what was true. And now the phrase at the top, it really is talking about, if you go and look at a publicly the financial statements of a publicly traded company like Tesla or Apple, when you go look at their balance sheet, the first thing at the top is going to say Apple. And then the second thing it says is balance sheet. And then the third thing it says is when that balance sheet was prepared, or what as of what date is that balance sheet accurate. And that is going to be super, super important information there. And so the general calculation I've got written down again. So truth be told, I would encourage you to, by the time you're done taking notes, you have all this stuff, everything that's on the board you have written down 3 times. It's good practice. So number 1, balance sheet as of a date, and then assets equals liabilities plus equity. So now let's talk about number 2, the income statement. Okay. Number 2, the income statement. How's that looking? Not looking pretty good, all things considered. Should have been. This presentation is actually a little more organized than what I did in class. For the year ended, and then really there's a date there too, because most companies, many if not most companies, the year ending that they're using is December 31st, but whereas a balance sheet is prepared as of a point in time, the income statement is prepared for a period of time, always for a period of time. It summarizes this activity, the revenue we earned and the expenses we incurred for a period of time. When you're looking at published financial statements, that period of time is a year. A company internally can prepare them for any old period of time they want to, but it is always prepared for a period of time. Okay? Let's look at number 3. Look at number 3. Okay? Look at number 3. There you go again. And this is the same as the income statement. For the year ended with a date. Okay, for you, because so again, cash flows. Think about your own bank account for this month. What came in, what went out. It's really, the balance sheet contains. If we look over at the balance sheet tells you how much was there as of that date. But this one, the statement of cash flows, tells you what did this month look like. How much cash came in, how much cash left, what did this month look like? And that's what's on the statement of cash flow. And then the statement of stockholders' equity, yet again, like the last 2 we've talked about, is for the year ended. With a date. For the year ended with a date. And let me kind of move the camera over there so you can see. Oh, you can see what I just wrote. Although you got to look real close. Hopefully you can see that from here when you put it on a big screen. Statement of stockholders' equity is prepared for a period of time, and it's only that end number, right? Ending stockholders' equity, which is an amount as of a period of time that winds up on the balance sheet, right? If you follow that arrow all the way to there, okay? And so not nearly as much fun as being in class. This lecture's shorter than class, right? Because it doesn't include all the in-class interactions with everybody, all the questions and answers that students might have. But here it is, all on the board. Hope you find this helpful for those of you who've missed class or for those who are studying for our first exam, which will be coming up sooner than we all expect. Yeah, so thank you for watching. Hopefully you found this helpful, and I will see you in class next time.